Today is April 20th, and you probably have taxes on the mind. For most of our working lives, we have been saving and investing in qualified accounts like a 401k or an IRA. For years, you've rebalanced and managed your investments in a tax deferred account, and you haven't had to worry about tax implications. But eventually, you may start to build savings in a brokerage account, a non-qualified account. And unlike your IRA, this account does have immediate tax consequences on capital gains or capital losses. Here's what you should consider when making trades in those accounts. Number one, when do you intend to take distributions or cash from this account? The U.S. tax code calls for a reset, if you will, of the taxation of the account upon death. If your account has significant capital gains and you intend to pass it to the next generation or die soon, the incentive to just maintain those gains increases. Your heirs will receive what's called a step up in basis, which essentially makes those gains tax-free. That said, if you are nearing retirement or a time where you plan to take money from your brokerage account, it may behoove you to do regular rebalancing in your brokerage account. This allows you to acknowledge those gains in a stair-step fashion and may help minimize the tax gains and spread them out over the years. As you probably know, 2022 hasn't been the best year in the markets. Rebalancing your portfolio during a dip can be a good time to get your portfolio back into the ideal asset allocation and potentially minimize taxes. And don't forget your total income. Yes, your capital gains tax rate may increase as your income increases. There is a 0% tax bracket on capital gains for couples earning less than $83,000. If you find yourself in a low income year, consider using that as an opportunity to rebalance and realize some gains at a 0% tax bracket. Number 5, look for loss opportunities. Any gains in a taxable investment account can be offset by losses. As you look to rebalance or make changes, compare the losses you have to your gains and see if those can help reduce potential tax liabilities. Number 6, don't forget your tax deferred accounts in your overall asset allocation. If you are already taking distributions like RMDs, you may be able to rebalance the overall portfolio by choosing to distribute overappreciated assets from your IRA. On the flip side, if you are still contributing to your accounts, use those contributions to purchase any asset classes that are underweighted to get your portfolio back in tolerance. And the same goes for reinvesting dividends and distributions. Generally, accounts are set up in the accumulation phase to automatically reinvest those distributions in the fund that originally created them. You can turn off that dividend reinvestment and then periodically use the cash that has built back up to buy assets that are underweighted. And number 9, finally, if you're just rolling in non-qualified assets with major capital gains and you don't need the money, consider gifting those highly appreciated assets to a charity. Generally, you'll get a full deduction for the market value of the stock and not have to pay tax on the gains. An old colleague of mine used to say, "Don't let the tax tail wag the dog." What he means by this is, yes, of course, consider tax efficient ways of managing your portfolio, but don't let taxes prevent you from implementing sound investment principles like regular rebalancing. Think of capital gains as less of an expense and more of a haircut on what you earned. As you age, it's likely you will need to de-risk your portfolio and sell some of those outperforming equities and replace them with a more stable security. An unchecked taxable account can, over time, balloon to a much more aggressive allocation than is appropriate. That's it for this week. This is Jeannie, the 401k lady.